I'm Matt Bouchard with NAREIT here at the New York Hilton for REIT Week 2017, NAREIT's Investor Forum. Joining me today is Mike Landy, the President and CEO of Monmouth Real Estate Investment Corporation. Mike, thanks so much for joining us today.
Thank you, Matt. Good to be here.
Now, in the current environment that we're in, is Monmouth focusing most of its growth plans via acquisitions or development?
We've been growing through the acquisition of built-to-suit. Industrial buildings today, there's strong demand for modern, omni-channel, business-to-consumer type buildings. So there's huge demand to have new space put on the market. Billions of dollars of sales are migrating from traditional brick and mortar stores to e-commerce, and that means you need something that can be capable of packing small packages and delivering them right to your home. So since 2011, we've pretty much tripled the size of the company through brand new built-to-suit acquisitions for investment grade credits.
And how would you describe the current state of Monmouth's balance sheet?
Well, we're one of the oldest REITs. We're a 50-year-old company. We've been a publicly traded REIT since 1968. And you can't be a survivor of so many real estate cycles without a strong balance sheet. And today, I'd say our balance sheet is stronger than ever. We're in such a historic low interest rate environment, and the yield curve is as flat as I ever foresee it getting. So we've been taking advantage and just fortressing our balance sheet. It's our weighted average debt maturities are over 10.5 years. Weighted average interest rate is in the low 4% range. All our ratios are well in investment grade territory. And one of the things we've been doing is financing our growth with preferred equity, because real estate's a long-term asset class, and it should be financed with long-term capital. And the market's ever increasingly focused on short-term these days, and you could certainly grow your earnings borrowing short. It's cheaper than perpetual preferred, but perpetual preferred equity, it never matures, and something you can maintain on your balance sheet forever. Last time I checked, that's a pretty long time, and so we have about $211 million in preferred equity at 6 1/8%, and it's very advantageous security to fund our growth.
Now, we've talked many times in the past about how e-commerce is driving demand for industrial space. Right. But can you talk a little bit about how it's changing how industrial space is designed, and are there any major differences you're seeing when you're talking to new prospective tenants?
There's a broad brush painting real estate, and every property type's different, and modern industrial is completely different from traditional industrial. Traditional industrial is a box that takes forklifts and pallets and ships them to businesses, but modern industrial is very automated and high-tech. The IT room alone is a several million-dollar investment that the tenant makes. The material and handling equipment inside the building can be at a cost greater than the building itself. So, for instance, in Dallas, what was once the largest mall in Texas is now a FedEx building we own. So the mall is gone. It's a state-of-the-art FedEx building. FedEx has invested over $30 million in the building. Processes over 15,000 packages per hour. It's highly automated, and it's the changing of the guards. People, their shopping habits have changed. Consumer spending is not shrinking. It's just migrating from traditional brick and mortar to your smartphone and being delivered to your home. So the building that's required to do that is vastly different. So I think building age is a key metric for investors to focus on, because there's certainly a use and demand for an older industrial building, but all the trends for future demand are for the digital economy, and it requires modern industrial space.
Mike, thank you so much as always.
My pleasure. Thank you, Matt.
For more from REIT Week 2017 and other REIT news and analysis, be sure to visit REIT.com.